none other than Brian Nick from NewEdge Wealth. Brian, how are you doing today?
Doing very well. It's an exciting day, as it's been for a long time.
Yeah, so our plan was to cover market impact from the Iran war. Obviously, last night we got some news, so Brian will be covering that with us today. The great thing is, even though there's so much chaos in the market, about 2 minutes before this webinar began, Brian was actually able to refresh his entire Macrobond chart pack. Did you learn anything new there, Brian?
I did. As I like to say, you're always one macro bond refresh away from having to completely retell your story based on moves in the markets, moves in prediction markets, as you guys will see in a minute, or in economic data. But the fact that you can do it cleanly and quickly is one of the reasons I love the tool.
Yeah. So just before we get into it, a quick intro on Brian. As managing director and head of portfolio strategy, Brian develops and manages customized portfolios for NewEdge Wealth clients, conducts due diligence and portfolio reviews, and publishes market and asset allocation research. He has over 20 years of experience covering the global economy and financial markets. Prior to joining NewEdge, Brian served as a senior investment strategist for the Macro Institute, following a 6-year stint as chief investment strategist for Nuveen, the asset management arm of TIAA, where he steered the firm's economic investment views and was charged with communicating those views directly to clients. Before that, he ran tactical asset allocation for UBS Wealth Management Americas after spending several years as a strategist at Barclays Wealth. Brian began his career at the Federal Reserve Bank of New York in the markets group, where he helped manage the Fed's portfolio and monitored European rate and FX markets for the open market desk. Finally, he earned a Bachelor of Arts in Government and Economics from Dartmouth and a Master's of Economics from NYU. He's a lifelong resident of Garden City, New York, where he resides with his wife and 3 kids. So, thank you all for joining us today. Brian, let's get started. Tell us a little bit about how the market was looking, but before the outbreak of this war, and maybe what those poly market odds were showing you this morning.
Sure. I think the thing it was way too long an introduction for me, but thank you very much for reading it. Importantly, the thing I'd add is that when needed, also an amateur geopolitical analyst because that's sometimes what you're called to do when you're in this type of job when it comes to giving advice to investors, analyzing markets and economic data. Certainly, that's been occupying the bulk of my time over the last month. Starting off with a disclaimer here, which is that obviously we had major news overnight with regard to the ceasefire or the purported ceasefire between the U.S. and Iran and the other players in the region. We don't have a lot of details. We don't really have any details in terms of what the substance of that ceasefire is, only that it appears that there will be a cessation for 2 weeks at least of military engagement once the ceasefire makes it down to all the individual soldiers and battalions stationed all over the Gulf region. But also that importantly, the Strait of Hormuz will be open in some way, shape, or form, which will affect energy markets, the transport and production of energy. But this could change very quickly. So we start off with this disclaimer saying that basically everything that happened at the end of the first quarter and that has already happened in the second quarter, the markets are responding to one variable, which is the availability of petroleum. Now, speaking of macro bond refreshes, you can see here that looking at these poly market odds, which we had in the macro bond tool for expectations of a ceasefire by the end of March, which obviously didn't happen, but then April, May, and June looked very different 1 or 2 days ago than they do today, where it seems like these are being paid off with a near certainty based on the news we've seen. So a lot can happen in one day. To your point, though, Hank, I think it's important to really assess kind of where we were from a macro perspective before the war started. It's hard to know where you're going to end up if you don't know where you started and where the potential pressure points and weak points could be in the overall economic and market picture. So I think quickly it's just worth summarizing. The U.S. economy in particular looked to be in quite good shape heading into the war, which started at the very end of February, early March. I love to use this Dallas Fed weekly economic index. It only tracks high frequency indicators that are published every week, but it really captures a lot of things: weekly jobs claims, retail sales, shipments, the volumes of shipments. And you can see that there was really no interruption in what had been a very long period following the pandemic of pretty good economic output. A lot less volatility here than you see in the GDP reports because of things like trade and government spending and inventories. This is just shows a very steady and arguably even an improving economy. When you dig into the details, and jobless claims, people filing for unemployment insurance, those have actually been going down recently. The number of people on unemployment insurance, despite what we know is to be pretty weak job creation in the monthly reports, the number of people on unemployment assistance has also been going down, a sign that you're remaining in this low hire but also low fire environment. So this is not flashing red or really even yellow at this point. And we had been seeing appreciating asset prices. This blue line here is showing you household net worth as a percentage of disposable income. And as that's going up, households are becoming wealthier, at least based on their income level. And what that has done over time is tended to bring down the personal savings rate. As it's a little bit counterintuitive, but as people become wealthier, they actually save less of what they make because they feel like they can fall back on that wealth. And that has been propelling consumer spending at a time when we know wages haven't been going up as fast, job creation is not happening as quickly. But the consumers who are doing a lot of the spending are consumers who are doing it from the perspective of growing asset base. Um, on the kind of negative side, kind of mixed side, inflation before the what we know is going to be a hit in terms of energy prices, that has also been behaving a little bit better. There's evidence that we may be seeing sort of the peak impact from the tariffs, which were enacted around this time last year. That's that kind of turquoise line at the bottom. Higher goods price inflation, but likely peaking out as the tariffs have, if anything, been pulled back somewhat over the last year. And you're seeing falling rent inflation as well. So some reason to be optimistic on inflation and potentially getting those rate cuts from the Fed. And then lastly, and maybe most importantly for investors, a lot of upward revisions to earnings expectation from analysts. We've been seeing better business sentiment surveys. That's the blue line showing you the ISM new orders, but also the black line, which is showing you on a year-over-year basis, have analysts been revising up their 12-month expected earnings growth for the S&P 500, and that has been going up very quickly. And that was what was supporting stocks heading into the period that we're in now.
Great. So it seems like, before the war started, generally positive or optimistic outlook for the U.S. economy. And, Brian, what we were talking about before the webinar began is that, we can be cautiously optimistic about the ceasefire, but these are notoriously fragile. So I think it would be helpful for the audience if you could walk us through the uh, potential possibilities or scenarios that you see ahead of the coming weeks and months here.
Sure. Well, the good news is the markets have sort of revealed to us what what the reaction function is to news of a ceasefire, even a tentative one. Investors really do want to believe that this is it and the worst has passed. So if the ceasefire holds, we'll see more of what we are seeing today in the markets, which is lower interest rates, higher stock prices, somewhat lower commodity prices. They're not going all the way back down to where they were pre-war anytime soon. And we'll talk about some of the implications of that, but also a relatively short-lived inflation bump, not month after month of high headline inflation. We know March and April are going to be ugly, but there was the potential for oil to rise even further and affect a lot of other energy commodities that consumers buy, and that could have affected inflation a lot longer. In this scenario where the ceasefire breaks down or just never takes hold, and we return to basically where we were at this time yesterday, we know that the formula there is that stocks are going to be challenged to make gains. Interest rates move higher on inflation concerns. Commodity prices obviously move higher on a risk premium, and we get higher inflation for longer. And then the worst case scenario, where not only does the ceasefire break down, but things escalate militarily, that's where you have much lower stock prices, probably a full correction, if not a bear market in stocks, lower interest rates, because now you start to move over this hill of how high do oil prices get? Are they so high that they're going to cause a global economic recession? In which case, interest rates are falling. Sharply higher commodity prices obviously go along with that, and some maybe permanent impairment of energy infrastructure or transportation. That would obviously be the worst case scenario. Thankfully, it looks less likely based on the last 12 hours or so. Um, I think it's also important to say the last month has already had an impact and will continue having an impact based on where energy prices have gotten to. But I'm using these very scientific terms here advisedly. Energy prices are at levels that will be annoying for U.S. consumers, but this will not be economically crippling for the U.S. economy. Certainly, it creates hardships for individual households, businesses that are operating on very kind of thin margins. But $93 per barrel oil is not going to be a recession level event for the U.S. economy. And frankly, $113 a barrel oil wasn't going to be either, just based on the fact that the economy has become less reliant on energy, especially imported energy, over the last 10 or 20 years. These are the things that are going to affect consumers and businesses moving forward, though. Diesel prices are close to all-time highs. They're not going to reverse quickly, barring some major event. And gasoline prices are not at the levels they got to in 2022 when we had the Russian invasion of Ukraine, but they are going to be higher for longer and certainly higher than they would have been in the absence of this conflict. So these are going to be staying with us now for some time. And we are going to continue to see stories about shortages in places like Australia, Asia, that depend on oil flowing out of the Gulf because no oil has been flowing out for a month. So we have this air pocket in global oil supply that is not going to be filled anytime soon. And we know that reserves have been substantially drained down to address that. Analysts came into the year, as I said, most of the economic data before the war was quite good. So you were seeing upward revisions to GDP growth for the year from consensus. That has now started to reverse based on what we think is going to be weakness from the end of the first quarter and second quarter in terms of GDP. Do we see a bounce back later in the year? Well, that will very much depend on what happens to energy prices and the overall direction of the war. But you can see a 2.25% GDP growth, very, very far from a recession. Still conveys some degree of optimism about the economy. And if we look at Polymarket for a little bit of a different picture here, predictions about recessions, you can see this time last year, right after Liberation Day, the tariffs, the prohibitive tariff rates on China that lasted for some days, weeks, not quite maybe a month. We had huge spike in recession odds on the betting markets. People really did think this was becoming the base case, and those quickly dissipated as the tariffs were largely pulled back and deals were sort of negotiated or renegotiated over the summer. And eventually, obviously, you ended up with no recession in 25 and 26. Maybe people learn their lesson, a little bit of a boy who cried wolf here, where there did seem to be what could turn into a recession level event for the US and the global economy, but investors didn't bite, or at least bettors didn't bite to the same extent. And now you're seeing those come back down as it looks less escalatory today. 27% somewhat elevated, but in any given year, you have a 20 to 25% chance of having a recession. The other thing that this has done is affect picture of what the Fed might do. This graph, the black line here is showing you the Fed funds rate, and these two blue lines are showing you expectations for Fed rate cuts, both this year, by the end of this year, and by the end of next year. See, it didn't really change the overall impression of how much the Fed's going to be able to cut over the next 2 years, but it did change the timing for those cuts. It's going to be very hard for the Fed, even a new Fed chair appointed with a mandate to get interest rates down, to cut rates at a time when you have headline inflation at 3.5, verging on 4% because of what's happening with energy. Yes, the Fed can and maybe should look through that, but it's going to be very hard to wrangle votes on the committee for rate cuts. So those have largely been priced out, even after the last 24 hours, where there's only a marginal chance of a rate cut priced in for this year. And what we are going to see in the upshot of all this is consumers are going to be squeezed over the next several months. Even if nothing else changes, even if energy prices fall from here immediately further, we are going to see somewhat higher inflation in the context of an environment where nominal wage growth has been coming down. This blue line is almost always and ought to almost always be above the black line, meaning that wages are increasing even in excess of inflation. At times where that's not happening, we have a name for that. It's called recession, or at least consumer recession. Doesn't happen very often, but we are seeing these two lines likely to converge further in the next couple of weeks and months, because we know the black line's rising where there's not much to indicate that the blue line's going to be moving up in tandem.
That's great, Brian. And I forgot that last year Polymarket odds got to roughly 75% of a recession. So really interesting to look back and see how that played out. So one final section here before we actually get to Q&A with all of the great viewers on the line, and probably the one that people care about most. How should investors position themselves given all this volatility in the market? I think we've seen S&P up 2.5% today. The last time I checked, we have kind of oil falling off a cliff. What's next and how should investors be positioned, Brian?
So one thing we really like to do when we're giving advice is making sure that we're basing that advice on what we think the most likely macroeconomic outcome is likely to be and how that would affect markets. But we also don't want to give people advice that will work especially poorly in the event that we're wrong. We want to have a couple of scenarios in mind of how things could turn out and pick something that will do fine or do very well in our base case, but will do fine in our worst case scenario. And so we kind of build a sort of a probability weighted selection of investment ideas in that way. Though our first investment idea is like just based on the pricing and based on what we still think is going to be a bumpy time for investors ahead with a lot of inflation news priced in, but not a lot of growth risks priced in yet, is long duration, high quality bonds, specifically municipal bonds. And I'll show in a minute kind of what the pricing indicates there and what taxpayers can get on an after tax basis or tax equivalent basis. U.S. growth stocks, another area that's really been pummeled this year. There's been a lot of divergence within growth stocks, but this is an area that was obviously very in vogue for several years and started to fall out of favor earlier this year. With the advent of the war and the huge spike in energy, we saw a move down in the valuation for those stocks, but at the same time, earnings revisions continued to be revised higher, which is a great argument for moving into them now. And then, sort of on the negative side, avoiding too much risk in your bond portfolio, avoiding equity-like risk, which is what corporate credit risk turns into in a downside scenario in your bond portfolio. So hedging against a recession, not easy to do. Not many things work. I'm showing you the U.S. Treasury curve here, which has been moving up, which has moved up substantially since the war. After today, this black line will have moved down a bit, but still interest rates are higher really across all maturities except the very, very short end of the curve than they were a month or so ago. And that's because the markets have priced in greater inflation risk, or at least greater risk that the Fed's not going to cut interest rates anytime soon. And so that's giving you a better entry point into bonds of just about every maturity in the high quality part of the market. Should investors run out and buy U.S. Treasuries? That's not necessarily where we think they should go. Where they shouldn't go, we don't think, though, is the corporate bond market. Owning corporate bonds as part of a diversified portfolio, there's nothing wrong with that. But you can see this spread is showing you basically how much you're being compensated for the extra risk lending to a corporation or a basket of companies versus lending to the U.S. government. There was a huge premium that investors got in terms of the corporate yield in 2022, when it really did look like we were on the brink of a recession scenario. We had a bear market in U.S. stocks. Even last year, Hank, with that 75% chance priced in of a recession, we had a very good but very brief entry point for corporate bonds. Again, sort of a boy who cried wolf scenario here. Not as much evidence that investors are panicking, let alone willing to sell their corporate bonds at discount basement prices today in this environment. We did see a little bit of a spike, but still historically very, very low spreads here on corporate bonds and just not compensating investors enough for the potential, if not the likelihood, that eventually we see something like this, and that really hurts your bond portfolio. So, the one thing we are doing is extending duration somewhat in most of the bond portfolios that we're managing and advising on. We're at much, much steeper yield curves than we were a couple of years ago when the yield curve was inverted. Short-term rates have come down. Long-term rates haven't come up exactly, but it basically stayed in that sort of 375 to 450 range generally. And that's given investors a little bit of a better entry point in terms of long duration exposure. And especially with municipal bonds, your yield to worst on the municipal bond index, which includes all maturities, so some short, but also some long duration, still looks quite solid. 371 doesn't sound fantastic, but when you tax adjust it and you consider what the yields you can get on corporate bonds, treasuries, and you tax adjust for somebody in the highest tax bracket, for example, what you can get on municipal bonds, 626 taxable equivalent yield is quite attractive. You have to go back a pretty long way to get substantially better yields than that, certainly further back than this graph goes. So this is an idea that we think is worth considering for investors, not only living at the very short end because the Muni curve is upward sloping, also being willing to take some longer duration risk there as well. And we think you're being paid for it. On the equity side, one thing that's been remarkable to see, and we'll have to update this graph after today's close, it will be substantially higher equity prices. That's the blue line. But the black line is estimated earnings, and that's been coming up quickly. Even during the month of March, when seemed like there were a lot of things to be concerned about, analysts were continuing to revise up their earnings estimates, specifically for growth stocks, including and especially technology stocks. It's unusual to see that happening as the market is experiencing at least a somewhat minor but very kind of notable correction with a lot of uncertainty ahead. Typically, you see these earnings estimates follow the price. You can see I've advanced the blue line about 3 months here. You would expect to see earnings estimates come down. This may have been a short-lived enough event that that won't happen, similar to last year, where we didn't really ever see earnings estimates come down substantially, even during Liberation Day. That means that stocks are, at this moment, even with the open we had today in the U.S., cheaper than they were a month ago. You can see on this graph, doesn't include today, but we have seen falling valuations on the S&P 500 off high levels for the cycle. That's not just about the correction from the war effect. That's also because of rising earnings estimates. And one thing to note here is we had a mantra coming into the year, don't fight the White House. Often it's don't fight the Fed when it comes to investing, meaning that you were going to see policy support for the equity market, or at least a withdrawal of policies that seem to hurt the equity market. Because what this graph is implying is that the blue line here, which is showing you the change in the PE ratio, the valuation of the S&P 500, when that's not rising, the economy is not growing at 2%. When it is rising, the economy is growing at 2% or more. So if your goal is to get the economy growing faster, create jobs, stir investment, animal spirits, you need the stock market support. Going all the way back to that original graph I showed on consumers. People feel wealthier because the stock market has gone up, they go out and spend more money. Stock market is a leading indicator for the rest of the economy. It's an important input into how investors as consumers and as businesses behave. And like last but not least, specifically on the growth stock question, we have seen a long, years long trend towards greater concentration in the performance of the market, in the formation of the index, and in frankly in the concentration of earnings as well. So looking at the equal versus market weight performance, the equal weight performance was doing well in the 2000s and the 2010s, peaked in 2015 and has done poorly since then because the market weight dominated by mega cap tech firms has obviously been the leader in the equity market. And this year, you were seeing a little bit of a reversal in this. And the question is, can that reversal sustain if the economy has been hit and is going to be a little bit weaker than we thought? Or is it in that sort of substandard growth scenario? Is it the high growers, the secular growers, the Magnificent Seven firms that are going to be doing a lot of the heavy lifting for the rest of the market? That would imply that we should continue to see this come down. So that's where we're placing the bulk of our chips at the moment, that this is a years long story that is going to continue, and that these reversals, which we've seen periodically, are going to be relatively short lived. I will stop there. Really excited to see what kind of questions people have on the investment landscape and on the macro picture.
Yeah, thank you for that, Brian. And we can now turn to our favorite time during these webinars, which is some Q and A's. So I see tons flooding in through the chat, and then actually it's being posed to members of the chat right now. And I think I'll start, Brian, with one that we've gotten from an anonymous attendee. In general, do you think there is a level of tolerance developing in the market to the Trump administration's unpredictable policymaking? If we have to restart the hostilities with Iran over the next month or so, or if there's another U.S. action, let's say in a place like Cuba, what do you think that we will have? What impact do you think those will have on the U.S. economy for the rest of the year?
Yeah, I'll start with the Cuba part, which it does seem like they're telegraphing that there's going to be some kind of effort to change the regime there. Cuba is certainly, from a geostrategic standpoint, has historically been a very important part of the world, very close to the United States. It is not as intrinsically, systemically important as Iran, and certainly as that region of the world because of the energy component. So I don't think that would be a market moving event. The Venezuela lies somewhere in between the two, the Venezuela decapitation strike, I guess you can call it, and the change in leadership there. Venezuela has historically been a very large producer of oil, so there was a market impact there. I think Cuba would be even a little bit less than that, and nowhere near what we've seen with Iran. The first question, though, is the big one. I do think the market has gotten used to a certain level of unpredictability bordering on chaos, at least in terms of the rhetoric, if not the actual policy implementation. I'm going to go back to that graph I showed, that the "Don't Fight the White House" graph, which is, we've probably never seen an administration that is as finely attuned and sensitive to the markets, that sees, and this is based on their public comments, sees the performance of the stock market as a barometer for success in overall policy, not just on domestic economic policy, but foreign policy as well. And any kind of actions, whether they're foreign or domestic, that are undertaken that seem to threaten the equity market, or drive energy prices significantly higher, there's an off ramp that is often taken quite quickly. And this is what the markets have sort of become inured to some extent. It's not just looking through the chaos, it's just assuming that the chaos is going to end with some kind of market friendly outcome. Because unlike other administrations that we've seen in the recent past, this administration definitely values equity market performance and recognizes, I think correctly, the connectivity between the performance of the stock market and the ultimate performance of the economy. Even for households that don't own a lot of stock, it's important to keep the economy well supported, and keeping investors risk on is one way to do that. So I think that there is a more concrete connection that's happening there in the minds of investors. It's not just, oh, okay, like we're not going to pay attention. It's, do we think all of this is being done with the ultimate goal of kind of extricating us from bad situations or getting us into better situations when it comes to places like Venezuela? And this was a case where it seemed like the outcome wasn't going to be good. It still might not be, but the fact that we have this ceasefire announced is giving markets a lot of that same kind of relief that, okay, we were right not to panic. It was surprising to a lot of analysts that you weren't seeing stocks go down further based on what we were hearing about the eventual path for oil prices. But there was this assumption that turned out to be, at least for now, correct, that you weren't going to be going down that path to 150 or $200 a barrel oil. There was going to be an off ramp well before that.
Yeah, it's quite interesting because, at the start of his term, everyone was talking about the taco trade. Trump always chickens out, and now it's like the strong action and then a quick off ramp. Markets really did not respond to Venezuela or to this most recent conflict with as big of a drop as many were expecting. So
You're comparing Liberation Day, right? That
yeah,
was
yeah, yeah,
really the first example. Yeah.
exactly. And with a lot of these questions, you might have to put on your geopolitical hat, as you were saying
Yes.
earlier, Brian. But I'll actually turn to the Fed now, one that's not completely focused on that. So futures markets are now showing a 60% implied probability that the Fed leaves rates unchanged for the remainder of 2026, up 5.5% from a month ago. Personally, I have a question there. Just, are you siding with future markets? Do you think that rates will be left unchanged, or do you see some change? And then this attendee asked, how are you repositioning duration exposure when rate cut expectations can reprice this violently in a month? So yeah, a lot to chew there.
Sure. Okay. I'll start with the first part, which is, again, the Fed has a dual mandate. So one of two things has to happen for us to get rate cuts this year. And I think that the most important thing is we need to see the labor market get worse. The Fed is not in a position with inflation, not just because of the energy price. I think we're going to learn tomorrow that we got a third straight month where core PCE inflation, which is the thing they try to get rising at 2%. That's their baseline. That we got a third straight month, probably in February, where that was well above target in terms of the pace of inflation. So it's going to be very hard for the Fed to look investors or the world in the eye and say, we think it's time to cut interest rates. And that was before the effect of energy prices, which they should be looking through, but which can affect other things like airline fares, transportation costs, which are in core inflation as well. So in order for them to be able to look through that inflation problem, even assuming it's in the rear view mirror for now, you need to see the labor market get worse. And the job report we got last Friday showed falling unemployment, and better job creation. Now, job creation numbers have been very noisy. Not all the labor market corroborates what we saw in that March payroll report, but it was good enough to make the Fed think, gosh, we really don't need to be in a rush here cutting interest rates. And while the president may be demanding that we cut rates and maybe appointing somebody in Kevin Warsh, assuming he's confirmed, who clearly has a mandate to cut interest rates, it's a democracy on the FOMC. And it just, there doesn't feel like there's a single vote, maybe with the exception of Governor Myron, who was appointed relatively recently and whose term will be expiring soon, to cut interest rates. So you don't have anywhere near a majority ready to do that. I think, unfortunately, to see lower rates, what you need to see is a much worse labor market, which we don't want. So at this point, as investors, we probably should be rooting for no rate cuts, uh, because rate cuts would mean that something else has gone terribly wrong. That not, wasn't necessarily the case earlier in the year, but based on the inflation data we've seen and based on the outcome of the war for now, in terms of energy prices, that's probably the best we can hope for is that rate cuts get pushed into next year once inflation dies down a bit. On the duration question, it absolutely is riskier to go further out on the curve. It's just a question of what you're being paid to do it. We've had a steepening of the yield curve. We've had a rise in interest rates everywhere, and I think what a lot of investors that I talk to haven't fully uh, internalized is that we are not. This is not 2015 or 2016, or certainly 2021, when interest rates were basically zero and you couldn't get anything for being in the bond market. Five, six, close to 7% yields on a pre-tax basis. That is attractive to us. The equity risk premium, how is the equity market valued versus the bond market, is quite low. You should not expect to see the same degree of outperformance stocks over bonds over the next 10 years as we've gotten over the last 10, which has been substantial because of the starting points that we were at. And so we do encourage investors to not only live on the very short end of the curve where it feels very safe, where you did well in 2022, a year where everything was falling apart. We think that things have shifted considerably in terms of the pricing, the starting point, the yields you're being offered, the upward slope of the yield curve. Even if you get some interest rate volatility, you're much better cushioned against losses today than you were at the beginning of 2022, which is the last kind of traumatic event that bond market investors can remember.
Yeah, very interesting. All right, this one we really are putting on the geopolitical hat.
All right.
Um, to what extent could Iran use the threat of closing the Strait of Hormuz as a long-term geopolitical leverage or advantage?
Uh, that's a very good question. One of the things that we're not getting clarity on is, do the terms of the ceasefire uh, include basically completely open and free passage for all ships that have been stuck to get out and ships that have been waiting to get in and load up on oil to get in, and not just oil, but natural gas and other things that are exported out of that Gulf? Or does Iran still retain some measure of control? Either do you need to get permission from the military, which is what the Iranian side has been saying? Do you need to pay a substantial toll per barrel or per ship, which is going to help Iran sort of re-enrich itself and rebuild? Those seem like things that could be consistent with a stable equilibrium, albeit with higher risk premium priced into energy markets. So we shouldn't be expecting in that scenario oil to fall back to $55 a barrel because the presence of Iran as a controlling entity in the Strait of Hormuz should raise the price of oil, both because of the tolls themselves and the potential that they could just close it again if something happens that they don't like. So what's going to be really interesting coming out of this is really Iran's only chip. They are obviously militarily overpowered, overmatched. They've had a lot of their military capabilities destroyed or severely degraded, but they retain the ability to control the flow of ships in a way that no other country in the region really does. So that's the chip that they're holding on to. It would be surprising to see them bargain that away completely, unless they're being given something else that they want even more. So what you're seeing based on the news last night that there will be some open passage, some free flow. It's going to take a lot of time to get ships out of there and let alone to get the ships to where they ought to be going. Australia, Japan, these places take a long time to get to out of the Persian Gulf. So we're still going to see that air pocket. We're still going to see acute shortages in a lot of countries over the next month or so. And the outcome of these 2 weeks of talks that are presumably going to be starting at the end of this week needs to be certainty for people operating in the Gulf, Who are you accountable to, if anyone? Is it going to cost more? Um, are you going to have to strike some a side deal with Iran to get ships through? And that feels like economically and from a market perspective, that could be a new equilibrium. Politically, from the US and Israeli side and from the side of the other Gulf states, it's hard to imagine that's going to be something that they can accept. So this is for me, the biggest source of uncertainty geopolitically in the region is the two sides seem incompatible on this question: who's going to control the strait? And we just don't have enough information on what either side is thinking to say for sure, except that some free flow through the strait has brought the oil price down substantially for now.
Yeah, it's quite interesting, and I know there's reports that Oman is also going to be, able to charge some type of fee as well. So we'll see how the region reacts. And there's obviously a lot of interest. Many of the questions in the chat are actually about the strait. So just to ask one more to continue on the topic, um, how are you stress testing your portfolio against a scenario where the strait is maybe reclosed or stays closed through Q2 and Q3? And do you have any trigger where you're going to kind of add or cut risk um, throughout this scenario?
So on the first question, I think we just had a great simulation for this. What happens if Iran closes the Strait of Hormuz? Very few things work. The thing, even hedges that people might have thought, hey, that'll work if things are kind of going haywire, like gold, silver, those did not do well at all in March. They've been rallying today with stocks because of the cessation or at least the announcement of the ceasefire. Um, Things like cryptocurrencies also, did not do well in March. Didn't completely tank, but didn't really provide much of a hedge to investors in the face of a falling stock market and struggles in the bond markets as well. The two things that if we were to get a resumption, that yellow or certainly the red scenario, the two things that we feel like would work in portfolios is cash and also long only commodity exposure, specifically energy commodities. It's hard. It's sort of an accept no substitutes type of deal. Like when commodity prices are spiking to that degree, they're rising in value, but everything else is seeing its value destroyed. I do think that the one change we've made to the portfolios is, again, I talked about duration. In an extremely severe scenario, you would see a peak in interest rates and then rates start to decline. So if you want a hedge against the real worst case scenario, as that red line showed on military escalation, you would likely see growth risks and global recession take center stage as the major source of concern because of the rise in energy prices to such a degree. And therefore, that would open up a whole box of other things that might perform well, like those higher quality bonds, longer duration bonds, very defensive parts of the equity market that tend to be correlated with interest rates, utilities, consumer staples, things that don't perform well when rates are going higher, but do in a risk-off scenario. Those are all things we can add to the portfolio. The second question on the trigger, um, we had a couple of levels in mind that we never hit for where we would be de-risking portfolios. One of those would be a 450 10-year. We talked about that internally as being a point where you would be basically back at the recent highs for how high the 10-year yield could go, and that'd be a place where we could be adding some portfolio insurance against growth risks. And then oil at $130 a barrel, where it never quite reached, could get back there, but hasn't at this point. And it's obviously been going very much in the other direction today, as a point where we would think that it would make sense to add more defensive exposure to portfolios. Maybe not adding oil at that price as an outright hedge, but adding some of those more kind of defensive oriented parts of the portfolio.
Well, I think everyone can be happy to hear that neither of those kind of risk-off scenarios happened, or we didn't reach those levels. So I think we have time, Brian, for maybe one more question.
Sure.
And I'm going to actually choose one that's a little bit different here and quite interesting. Um, you might not have a take specifically on food inflation here, but just on overall inflation. So the question is, since it's peak planting season here in the northern hemisphere, how do you think higher fertilizer prices today eventually show up in food inflation later this year? And what data are you watching to know when that impact starts? I know that's quite specific. So, also just overall, given the macro environment, do you see this kind of stickiness of inflation holding, or what are your expectations for the rest of 2026 and inflation here?
Yeah, it's a very well-informed question because when people ask about food, usually they ask about sort of core commodities like wheat and corn, and those can fluctuate wildly in price, and those can have huge supply disruptions. But ultimately, that's not most of what goes into the price of the food that we buy in the grocery store, or the food that we get in the restaurants. It's fertilizer costs, which we know have gone a lot higher because a lot of the kind of critical ingredients come out of the Gulf. It's not just oil and natural gas; it's these other sort of kind of core ingredients that many of which I have trouble pronouncing on the fly, but come out of the same region, and that will affect the planting season currently because just as no oil has been coming out, these fertilizer precursors have also not been coming out, and transportation is another one. How does the food get from where it's grown to where it might be processed to where it might ultimately be sold? Those diesel prices that I showed are not going to come down quickly. And that's another source of inflation, certainly, that we'll see incorporated into food prices. So if you're expecting easier food price inflation, lower prices at the grocery store, maybe not even flat prices, let alone lower prices, you're going to see those expectations pushed back considerably here. The one positive we can say is that if we get more flow in and out of the Strait of Hormuz and the Persian Gulf, this dislocation and this pocket of very high prices based on very scarce supply will be relatively short-lived. And there are stores of all of these commodities around the world that have been drawn down to sort of assuage or to mitigate the impact overall of the supply disruption. If we can get things back to normal, you shouldn't see a prolonged period of extremely high food and energy price inflation. So inflation and the CPI inflation peaked at 9% in 2022. It didn't stay there for very long because oil prices went up a lot during the Russia-Ukraine war, the advent of that war, and then came back down pretty quickly. And the Fed was raising rates at that time too. I don't think we're going to get anywhere near 9% based on the circumstances we're living in today, but we could get to 4% or 4.5%, depending on the how much of the food and the energy price in the headline stays where it is or gets potentially worse. And the overall inflation, a core inflation the Fed pays attention to, is already too far above target, 33%. It looks like it's going to be going higher. And a lot of what goes into that are wages, which we're not totally worried about, real estate, rent and home prices, which are also has also calmed down, and then some transfer from headline from food and energy, which is a concern. And so this gets back to the Fed question, like what does this all mean? Yes, higher inflation, higher food inflation, higher energy inflation for March, April, probably May. And then you start to see those year-on-year numbers come down because the monthly inflation rates don't quite keep up. And they start to slow down, and the year-over-year number peaks and comes back. But that's going to push out a lot of things that we want to see happen and that the administration would like to see happen, and the investment community would like to see happen, which would be lower interest rates, higher stock prices, stronger consumer. I do think we are in for a period where the consumer is going to get squeezed. That graph looks a little bit too much like the Strait of Hormuz, the graph that shows the rising inflation and falling nominal wage growth. If that crosses, we're in for a tough year economically. There's going to be a lot of consumers that are going to have trouble making ends meet.
Well, Brian, I just want to say from the whole Macrobond team, thank you so much for your expertise and time today. I think in 45 minutes we covered quite a lot. So I want to thank the audience for joining us today, and thank you for all the amazing questions that came through the chat. And yeah, hope everyone has a great rest of their day today. Thank you, Brian.
Of course, thank you.